Welcome to part 5 of the ICT Mastery Blueprint. We're going to be talking about market structure shifts and breaker blocks. If you haven't watched the last videos, you definitely need to watch those videos first. Learn about liquidity and imbalances, internal range and external range liquidity, how the market moves, before you can continue on with the series. So this is episode 5. Not going to waste any time. Let's get straight to it. Okay, so this is the front cover, market structure shifts and breaker blocks. So what is a market structure shift? Very simply, a market structure shift is an indication that price gives us that we are shifting structure, meaning we are shifting from either bullish or bearish market structure, and you can use that information in your trading. So it's a simple indication that the market structure is changing from bullish structure to bearish or from bearish to bullish. So this is what it can look like visually. You can see we've been bullish and then we get a market structure shift, and this is where you'd expect bearish market structure, and on the other side we've been bearish and then you see a bullish market structure shift, therefore you can potentially expect bullish market structure. So how do you identify a market structure shift? So a bullish market structure shift is a candle closure above a short-term high after liquidity has been taken. Like I said, if you haven't watched the video on liquidity, you need to watch that first. So once we close above a short-term high after liquidity has been taken, you have a market structure shift. Now, I know some people teach that you do not need a closure above. It can simply be a wick. For me, in my back testing, I've always used closure above. I did not find the setups to be as high probability when you're using simply a wick above. It needs to be a closure above for the purpose of my trading. Obviously, you guys are able to do whatever you need to do for your own trading. A bearish market structure shift is a candle close below a short-term low, again, after liquidity has been taken. So what does that look like? In this example, we have a low, right? And we have liquidity taken out here. Then we get a candle closure below the short-term low. Therefore, this is a bearish market structure shift. So if price was bullish and you were bearish at this specific narrative, you could expect lower prices. In this example here, we have a bearish market structure. We put in this short-term high, we take out liquidity, and then we get a bullish market structure shift identified because we closed above this old high. So let's talk about breaker block. So a breaker block is a PD array, which you should know if you were watching the last couple of videos. It is a PD array that can be referred to algorithmically as the price range or candles where market structure shifted. So a breaker block refers back to the candles or the price range given inside those candles that allowed or were placed for the market structure shift. So that may sound complicated, but it'll get some more simple. So in other words, it's simply a pattern, but I don't want you to think about it as a pattern. I want you to think about it more algorithmically as a reference point to where the market actually shifted from bullish or bearish. So you're trying to identify that reference point of where price shifted, right? So what does a bullish breaker block look like, or how does it form? When price action places a low, so a swing low, a swing high, and then we get a lower low, meaning we swept liquidity because we took out that low, and then we get the market structure shift, which is a higher high, so a closure above that high. So low, high, lower low, higher high, and you don't have to remember this because we're going to go over it in the video. This is when price forms a bullish breaker block. The breaker block is referred to as the candle or candles that were closed above after the liquidity was swept. And I'll demonstrate this. So over here, we have a low, high, lower low, higher high, meaning we swept out this previous low, and then we got a bullish market structure shift, which we know how to identify. The breaker block refers to the candle or candles, the up close candle or candles that were closed above. So these two up close candles were closed above after the liquidity has been swept. So this price range is your bullish breaker. In the bearish scenario, it's when price action places a high and then a low and then a higher high, meaning we swept liquidity resting above that old high, and then we get a lower low in the form of a market structure shift. So we close below that low. This is when price forms a bearish breaker. The bearish breaker block is referred to as the candle or candles in that price range that were closed below after liquidity was taken. So over here we have a high, a low, and then a higher high sweeping the liquidity above this high, and then we get closure below that low. Once we close below this low, your breaker block has now formed. We've shifted structure after liquidity has been taken. You can refer to the candle or candles. In this case, there's two consecutive ones. And this entire price range is your bearish breaker block. What is the importance of a market structure shift in a breaker block? You can use this in your advantage in trading to determine where the market's likely to trade based on market structure, and entries in terms of confirmation on the lower time frame of when price is going to shift. So you can use them on the lower time frame as a confirmation tool, or for a shift in market on the higher time frame, where you can also use them as building a narrative. So for example, and I'll minimize myself here, I'm very tiny, but just focus on the picture. Imagine you have a higher time frame bearish breaker block, right? And we trade up towards it, and then we get a lower time frame breaker block. So high, low, higher high, lower low. We swept liquidity above this high, got closure below that low. We referred to the down closed candles that were closed below, and this is your bearish breaker. So we trade into a higher time frame breaker, forming a lower time frame breaker, and that is your confirmation tool to enter shorts. In this example of the bullish scenario, we have a low, high, lower, higher high, meaning we formed a bullish breaker from a higher time frame bullish breaker, and we get a bullish breaker identified by the two up close candles that were closed above. So right here, we closed above these two up close candles. We got the market structure shift, and we swept out liquidity already. So this is a bullish breaker. So what is the criteria for a high probability market structure shift or a breaker? 1, forms in the direction of your drawn liquidity. It does not matter if we formed a bullish breaker if you're expecting lower prices. It is simply a fake run then. It all determines on which direction you already expect the market to trade towards, right? This forms after liquidity is taken. Like I said, you need to see liquidity taken out of the marketplace before you scan for this. If it forms with displacement, you want to see a nice conviction in speed and displacement of the candle that's forming the breaker. If it's forming very slowly with a lot of wicks, lack of speed, lack of large body candles, it's not as a high probability breaker. Finally, if your breaker block overlaps with other confluences, for example, a order block or a fair value gap, which we'll cover, or some of which have already been covered, that would make the breaker block higher probability. So let's cover an example of a high probability scenario. You can see we swept on old liquidity over here. In doing so, we formed a low, a high, low, a higher high, then a lower low. So we swept liquidity above this high and then old level. And then we get the breaker because we closed below the low. Notice the displacement in this candle is very strong, and it forms with speed because of the larger body. And then we get the bearish breaker block, referred to as these two down closed candles. This breaker block also overlaps with this order block, which we'll cover in the next episode, and this bearish fair value gap. So this would deem a very high probability bearish order block. We also have a drawn liquidity lower, making this pretty much an A+ breaker setup. In this example right here, we have a low, high, lower low, higher high into a key level where we swept liquidity. We also swept the liquidity resting below this low. Then we get displacement. You can see a very quick speedy move higher, closing above this high, forming the breaker block. So these two up close candles are the breaker block. And you can see we also have the order block in line, which we'll talk about next video. And then you have the bullish fair value gap right here that also rests overlapping with the breaker, making this a high probability breaker. Because we have a drawn liquidity higher, this again is an A+ breaker setup. So let's go into the real charts now, and I'll give you guys some examples of trades I've taken, as well as some stuff that we can review when it comes to market structure shifts and breaker blocks. All right, this is an example from this morning. Just want to give you a quick example of a bullish breaker block. So you can see over here, we put in a low, high, a lower low, and then a higher high, right? And we did take out sell side liquidity. So over here, you have this up close candle and this up close candle. If you actually zoom in, you'll notice those swing. So the low, the high, the lower low, and the higher high, you can actually see it very clearly with just one up close candle on the 2-minute time frame. If you go to the 1-minute time frame, you'll see a little bit of discrepancy between this candle and this candle. Now it's always going to be the last up close candle before the liquidity sweep. So you would be marking this out as your breaker. However, if you go to the 2-minute chart, it's a little bit more clean because there's only one candle. So you can always mark out the 2-minute breaker in itself or the 1-minute breaker. It is completely up to you. But this would be your 1-minute breaker block. Low, high, lower low, higher high. We swept out liquidity. Let's say we were bullish. You can see we got that nice displacement speed. We trade back into the breaker block 1, 2, 3, 4, 5 times ish. But once we get the closure above, we're going to see right there, that is the closure above. This would identify this candle as the last up close candle before liquidity was taken that got closed above. So we closed above this specific candle, this last up close candle. Liquidity was taken and we closed above it. So refer back to the candle after liquidity was taken, and then that is your bullish breaker. We're going to do an example of the daily chart where we have a market structure shift that leads into bearish order flow. So you can see price trades up here on the daily chart. We take out liquidity resting above these highs right here, right? And then we get aggressive displacement down and we form a bearish market structure shift. Why just a bearish market structure shift? Because liquidity was taken, and in doing so, we closed below the short-term low that was put in during the liquidity sweep over here. So we took out liquidity and we closed below this low, meaning we are entering bearish market structure. It's a higher chance of bearish market structure. Obviously, not every single bearish market structure shift leads to bearish market structure, but it is a very good sign that the market is going to reverse. You can see we have bullish structure here. Market takes out buy side. We get a liquidity market structure shift here, and the market becomes bearish. All right, this is an example of a trade that we missed on Tuesday, but we were able to call out very nicely. So what happened here? You can see price puts in a high, a low, a higher high, and a lower low. So it basically looks something like this. So you can qualify this entire leg as a breaker block. So how would you do this? Going back to the lowest low here, you can extend this out in time and view a market structure shift because of the closure below this specific level. So your breaker blocks don't always have to be within 2 or 3 candles, right? It can be in an entire price leg. So we have bullish structure here, high, low, and then we're making higher highs. And until we make that lower low, there's no breaker block. This is the 15-minute time frame on NASDAQ on Tuesday. So you can see we have a high, low, higher high, lower low. So if you were to annotate these 2 candles as a breaker block, right, extend that out in time, you can also notice that once we formed that, we formed in this bearish fair value gap. So when you have a bearish fair value gap, now listen closely, once you have a bearish fair value gap, and we'll just annotate it with these lines right here. So I'll draw this up quickly. When you have a bearish fair value gap that's aligned with a bearish breaker block, we actually call this the unicorn setup. So this is one of ICT's trading models where you have a breaker block with a fair value gap. You can see the market trades into that level and then immediately reacts off of that unicorn setup, taking out the equal lows, for example, if that's what you were aiming for. And there's also an open imbalance right here. So it kind of makes sense to where the market was drawing towards. But you can see how that breaker block setup on the 15-minute time frame kind of sponsored this move lower. You have a sort of accumulation, manipulation, distribution setup here. And come 9:15 pre-market, we trade into the breaker, and then 9:30 volatility comes and we trade immediately lower towards the objective. Now, what I want to do is actually go back to the time in which this specific price action happened. So notice, once we got that 15-minute breaker, what actually happened in market structure. So this is, at this point here, the 15-minute breaker has formed, right? We have closure below that specific level. But notice what the market actually does. Now, look closely. This is fascinating. Look what the market does, and I'll put myself in the corner here so you can see the entire picture. We put in a high and a low, right? So a high and a low, and a higher high, and then a lower low. So in forming that 15-minute breaker block, we actually form our own breaker block on the 1-minute time frame. And you can see we also form this bearish fair value gap right at 9:33. Now, again, we were calling out this trade live, but I did miss it. I just wasn't too confident in lower prices. It formed a little bit too quickly for me, but you can see we have a high, low, higher high, lower low. And in fact, if you were to zoom into a lower time frame, you would also see this as a breaker block as well. So however you want to view it, you can view the market structure shift here. You can view this low as a market structure shift. All in all, it is all the same. We have a low, high, high, low, and then a higher high, lower low, and we touch that 15-minute breaker block, form a 1-minute breaker block, And from that, we get this bearish fair value gap that you can use as an entry, or you can enter simply after the market structure shift, however you want to enter. This video is not about entries, but this kind of relates to the PDF in that example of when we trade into a higher time frame breaker block, and then we get a lower time frame breaker block forming off of that level. So that's kind of like a double breaker formation, confirming the move lower, especially if you're bearish. So that is one very high probability setup that you can look for. And obviously we have the fair value gap aligning on the 1 minute chart with this market structure shift, and you have the 15-minute bearish fair value gap aligning on this chart with the 15-minute market structure shift, right? And with a clear drawn liquidity lower, this is practically an A+ trade. All right, I have one more example for you guys. Is on the lower time frame. So you can see price has been very, very bearish, right? And then eventually we reach into a key level, which we can annotate something like this, right? And what happens when we reach that key level? You can see price puts in a low, a high, a lower low, and then we eventually get that higher high. So if you were to mark out the last up close candle, right, the one where I formed the market structure shift, and then you mark it out as a bullish breaker, you can see we have a fair value gap resting right inside that bullish breaker right here. So hopefully you guys can see that bullish fair value gap inside this breaker. So low, high, lower low, higher high. Your market structure shift is qualified once we close above this level, and you can see we definitely closed above this level. So this is your market structure shift after liquidity was taken. We get that closure above, and you can see how you get that market reversal towards the buy side and eventually trading up even higher. So this is another example of the unicorn setup where we have a breaker block aligning with a bullish fair value gap, again after liquidity was taken, making this a high probability trade setup. Okay, so that's all we're going to be talking about for this video. I hope you guys learned something about market structure shifts and breaker blocks. Now, sometimes the market does not form a clean market structure shift or breaker block, which is why the next episode we're going to be talking about change in state of delivery and order blocks, which is another signature used in the exact same way, just a little bit different the way that it actually prints on the price, in terms of price, and how you can view it in the chart slightly different. Nonetheless, pretty much a very similar concept. You can use one or the other or both. I personally use both in the exact same way, which we'll be covering next video. If you guys like the series, I appreciate if you guys left a like, subscribe if you want to see more content. Until next time, peace.